Hi, this is Nilus Mattive for Money and Markets TV. Over the past few weeks, I've covered a lot of ground in these videos, from dollar cost averaging to more advanced option strategies. And a lot of you have followed up with great questions. So today, I want to try and give you some answers. First, Pat says, you used the example of selling a covered call option on a stock that you bought for $30. You set the strike price for $35 at a future date. Why would someone buy the right to buy the stock for $35 at a future date when they could simply buy the stock itself if it reaches $35? Well, first, Pat, I should point out that I was creating a simple hypothetical example with round numbers, not any actual situation. But what you're really asking is, why do investors buy options at all? In the case of our example, the hypothetical investor is speculating on a rapid gain in the stock price. He or she is hoping the stock goes not to $35, but well beyond that level before the option expires. Let's say they paid $100 for the options contract. In that case, they'd need the shares to go to $36 before they break even, because each options contract consists of 100 shares. And any move beyond 36 would represent a profit for them, minus commissions and taxes, of course. But the point of buying the options contract rather than just buying the stock at $35 is that they only risked $100 versus $3,500 to own the actual shares. That's the advantage of speculation with call and put options. Your risk is strictly limited, and because they're leveraged investments, they give you tremendous profit potential for relatively small amounts of money. Now, I also had a few comments on my recent argument in favor of dollar cost averaging. I pointed out that using the strategy to buy shares in an ETF covering the 500 would have made you a profit of 18.6% over 4 years, while the broad index actually declined. But a viewer named Frank said that I forgot to factor commissions into my example. And another viewer, MJ, said that an 18.6% return sounds nice on the surface, but that it's over an entire 4-year period. The actual return is only 4.65% per year, which is unacceptable to most investors. Well, first of all, it's true that I didn't include commissions in my example. They would have likely lowered the overall return of the dollar cost averaging strategy. But my feeling is that commissions are now so reasonable, especially if you choose a low-cost online broker, that they should rarely be a major consideration in adopting a particular strategy. Moreover, if you're averaging into index funds, either through your brokerage account or an automatic retirement plan such as a 401k, it's entirely possible that you're not paying commissions at all. But what about MJ's point that even if commissions were factored in, an 18.6% return isn't acceptable? Well, obviously, it's up to each individual investor to determine what level of profit is acceptable to meet their particular goals and risk tolerances. But I do want to make 2 points. First, for a more conservative portfolio, and given prevailing interest rates over the last 4 years, I consider a consistent 4.65% annual return entirely acceptable. It certainly beats just having cash parked in a CD or a money market. Second, I wasn't trying to say that dollar cost averaging is the path to huge returns, nor even the best way to approach the stock market. Rather, it's merely a solid way to reduce your risk and still participate in equities without having to time things perfectly. Remember, it's always easy to look backwards and find the perfect strategies and investments for a given period, but it's a lot harder to predict what will perform best in the future. I'm Nilus Mattive for Money and Markets TV. Thanks for watching.